Okay, welcome back to the next lecture in my technical analysis module. This is going to be a multi-part lecture of a couple of sections each, but this section will be covering the basics and some of the more intermediate aspects of what may be the most fundamental aspect of technical analysis, and that is support and resistance. In this lecture here, we will be discussing the basics of support and resistance, some ways to identify them, and more importantly, how they form and why they form. Support and resistance are the most fundamental building blocks of technical analysis. They mark the areas where price tends to reverse, pause, accelerate, and sometimes break through to make new highs or lows. So these are not just lines on the chart. We are looking at zones on the chart. This is a big thing that we are going to discuss, probably the most misunderstood or mistaught aspect of support and resistance is that it is a single line, when that is just not the case almost ever. But they are the visual footprints of where supply and demand outweigh each other in certain instances. But the first thing that we need to discuss is that there are different types of support and resistance. A lot of the time, you will hear the terms supply and demand being thrown out there, and sometimes support and resistance aligns with the supply and demand zones, but that is not always the case. So we are going to break down the difference and how you can use either of them in your trading. Now, the first thing to mention is a really common and very practical way to use support and resistance is looking at prior highs, prior lows, and leaving a line. I like to mark simple support and resistance levels with lines, and I like to mark supply and demand zones with boxes. Let's start off with discussing what support is. So support is a price zone where buying pressure is strong enough to halt or reverse a downtrend. In these zones, we see demand for the ticker or asset, equity, whatever you're looking at, is exceeding supply. In these zones, we see buyers step in, often defending these levels multiple times and not allowing price to head lower. Price tends to bounce when revisiting this zone. So usually this is a spot where a lot of people bought at and thus will set their stop losses at break even. So here's an example. This is on the QQQ 5-minute chart. This was about a week and a half, 2 weeks ago. This is just a really good example to look at here. We had a massive downtrend here, where in this zone, we saw price spot up once, twice, 3 times, 4 times, 5 times. After the first bounce or so, buyers in the market started to realize that anytime price entered this zone, price action would head higher. So the reason that this happens over and over again is buyers who maybe missed, say, this first move, set a buy target in this zone with the logic that if price comes back into this zone, it will do what it has done the last several times and bounce. Thus, it becomes a self-fulfilling prophecy where the reason that price action bounces is because enough traders and market participants believe that it will. And on the flip side, this is often a spot where traders went short and set a stop loss at break even. So some traders may have gone short in this zone, and as price went higher, the stop loss was back in the zone. So they were able to close their short positions, thus buying back QQQ, sending it higher. Again, support is not a guarantee, and once it is broken, it will often flip to resistance, another topic we will discuss a little bit later. And on the flip side, in a very different type of example, we have resistance. Resistance is a price zone where selling pressure overcomes buying pressure. We're going to go back to the top here. This is the QQQ weekly chart going back several years. This is the top that occurred near the end of the massive bull run in 2020 and 2021. For QQQ, this ended in about November, December. This was a very solid resistance zone, a location where supply exceeded demand, a spot where sellers were very willing to unload positions, and we saw Price retested this level several times before ultimately heading much lower during the 2022 bear market. So price in resistance zones tends to stall or potentially even reverse when approaching this spot. Now, a really cool fact about support and resistance is due to the nature of buyers and sellers and the way that positioning is done in the market, when a prior resistance level, in this case, is broken, which it did see in late 2023, we did see some price action stalling there before heading higher. These zones, once broken with strength like this, will often later on act as support. So this is not a coincidence that we saw in the recent dump we saw in April of 2025 due to the tariff fears during Trade War 2.0. The bottom on this downtrend was exactly the same zone as the top of a prior uptrend. You should be using this logic to your advantage. This is obviously a very extreme example of multi-year long trends and supports and resistances, but the principle remains true even on the smallest of time frames. So the major reason that we consider support and resistances to be more zones rather than a singular price level, and using singular price levels like this is fine as long as you understand that the major reason that the stock market moves, or any price or stock moves, is because of institutional money or large traders. The small retail traders like you and I are not influencing price in these major moves. We are simply playing along with what big money is causing price action to do. So institutions, they buy and sell positions with massive size. So when, say, an institution went here and shorted the market at this price here, after we had topped out here, stalled for a while, shorted here, they're not getting filled on $1 billion worth of shorts at one singular cent or dollar amount. That is not the way the market works. There is simply not enough liquidity at specific levels from retail traders and other major players to get an exact fill like you or I may, taking a much smaller position. So because of this, liquidity is distributed across a major area, not just a singular tick. So an example, say if a stock has resistance or even, let's say, support at $100, you might see that buying pressure and that range go from 99.70 to 130. You're not necessarily going to see all of that price action taking place at a singular point. Now, the reason support and resistances work in the long run is because they act as the decision points in the market. The market remembers what has happened before for two reasons. One, traders see what happened before and attempt to replicate it again. This is a good example where price hit this level here, fell, went a little bit higher, fell again, and ultimately once we hit this level a third time, price stalled temporarily before breaking out. Now, if we were to see price come back to this prior level, there's a good chance it would act as major support. One of the main reasons that this happens is because at these prior highs and even at this level here, there were a lot of orders that not only occurred, but that were potentially left unfilled as price action went very quickly away from this level once, twice, and well above it once. So it is a psychological level for institutions to place not only stop orders, but also new buy orders. So the main things to be looking for as support and resistance are prior highs, prior lows, a breakout point or a breakdown point, gap openings, and high volume trading days. When there is high volume, that means a lot of positions in this price zone were opened, meaning that if price returns to this level, there's going to be a lot of positions needing to either be closed or more traders will be opening positions at this level once again. So this memory, with air quotes, can cause traders to act again when price returns to those levels, which is a self-fulfilling prophecy in the long run. So again, those who shorted at support often have a stop loss at break even, while others potentially look to go long if price retests. And to the flip side, those who went long at resistance often have a stop loss at break even, while others look to go short if price retests. These are all self-fulfilling prophecies. What you have to consider as a trader is that support and resistances ultimately form because markets are a constant battle between buyers and sellers. The zones that you see on the charts are not random. They are the visible result of human behavior, order flow, and the mechanics of supply and demand. Support exists because the demand for buyers is higher than the supply that sellers are willing to give at that zone, and the opposite is true for resistance. So, again, large traders cannot enter full positions in one order unless they can get retail traders to fill them with liquidity. Thus, big money tends to move price into these prior zones in order to get liquidity to buy or sell to retail traders. Another very critical point to remember is that there is a lot of memory in individual prices for traders. So an example would be if price bounced hard at 250 last month on whatever stock, traders say, okay, I'm going to buy there if price goes there again. And vice versa. If, say, every time we hit 410, sellers step in, traders say, all right, I know when we hit 410, there's a sell-off. I'm going to sell right at or right before we hit 410. So many traders place stop losses just beyond obvious support or resistance levels. So here is an example that is a brilliant one. If you were simply trading on exact price lines, you saw this prior high here, you potentially could have said, okay, if we barely break above this level, I'm buying. Ultimately, we saw price go just above that level here. Big institutional money could have sold you that position to take a short while you are now stuck at the top. So institutions and big money will push prices just past obvious lines in order to get liquidity from retail traders. This is why if you are setting stop losses, you want to be placing them beyond what is an obvious support and resistance level, because there are going to be many times where you are going to be stopped out just barely passing the level before we ultimately reverse potentially in your initial direction. So a break of support, we'll see a lot of stop losses trigger and selling pressure can accelerate. Now, another major reason that support and resistances are critical is, as we mentioned, a lot of traders like to place obvious buy or sell orders just beyond these levels. So if, say, there's a major stop loss right beneath support where a lot of traders are placing stop orders, if we meaningfully break support, we can see a lot of stop loss orders filled, thus pushing price lower. And the same is true to the upside. So if you look here, there were obviously a lot of buy orders waiting just above this prior resistance because we gapped above this resistance and instantly went on a massive run where price went up basically every week for weeks and weeks and weeks on end. And this is a self-fulfilling prophecy. People are waiting for the resistance to break to buy, and thus a lot of them place the buy order right at resistance. Thus, when we break that level, lots of buy orders are filled and price is propelled much higher. So big players like to do something called liquidity hunting, and this is exactly what we are talking about, where sometimes they can be looking to bring price just beyond an obvious support or resistance in order to get retail traders trapped into having positions filled before reversing in the other direction. So the liquidity hunting algorithms and large players know this well and will push price just beyond these levels to trigger the stops and reverse. So again, it is very important from a principle standpoint to place your stop losses outside what is obvious support and resistance so that you aren't a part of the retail group that gets hunted by the liquidity hunters for a big institutional move. Something else to consider for support and resistance is psychological big numbers. Think about when you've bought a stock and said, okay, if this stock hits $100, I'm selling at $100. So I'm placing my take profit at $100, or I'm setting my stop loss at $100. As humans, we look to big, clean numbers naturally as our major profit targets and take profits. You've done it, I've done it, we all do it. And that is why these levels tend to act as major levels. So this is QQQ. Take a look at some of these major levels that we've seen before. Look at 400. This was a level where we saw a lot of buying. Look at 500. This is the level we saw a lot of selling, and thus major gaps and a lot of interesting price action has taken place at the big round numbers. And that is because traders will take and make trading decisions with these large numbers in mind. Take a look at Apple here. Some of the major psychological levels have been big over and over again. Look at the 200 level. This was a major resistance where people were taking profits time and time again, as that was a big round hole number, and we've seen that level act major before. Or go to 250. We had another major top right at about 250, almost to the cent. If you look at on the left, you can see the high. This candle topped out at 250 exactly. These major levels are very important, and every trader in some way uses psychological big numbers. And one more example, if we look at NVIDIA, we see 150 was a big psychological resistance, 100 was a psychological resistance, gap level, and support later on. These big numbers play out over and over again. So my recommendation is when you are setting a take profit, or when you are setting potentially a stop loss, go either just beyond or just before major psychological levels, as this is where a lot of traders are trading. If you're taking options positions, and sometimes you'll think, I'm going to take a QQQ 600 call because it's a clean number, that's what everyone else is thinking as well. You don't necessarily want to be taking the same position as everybody else, as the big money is looking at just that as well. Another thing you're going to want to be doing and using as a tool in your trading is looking at unusual volume. Unusual volume can pretty consistently measure price highs and price lows. So let's take a look at the bottom here. The highest volume day on this downtrend was the exact bottom of the trend. And vice versa, you look at the lowest volume days at the top, marked right here, these low volume days measured the top of this price action. You want to be looking at what average volume is over a relative run, and if you see an unusually low or unusually high day of volume, that can often mean that a trend is either one, changing, or two, going to continue in a dramatic fashion, as there could be sustainable volume behind the move. So some quick reminders on in trading tips if you are using support and resistance, and we're going to be looking a lot more at how to draw these levels precisely and zones precisely as we go further into this concept of support and resistance. But if you are taking long positions, put your stop a little bit below the support zone, okay? And for short trades, place your stop a little above resistance, because the big money is targeting these obvious levels and will push price beyond that to fool traders that the level has broken. Put your stop losses a little bit beyond these levels, and you will avoid a lot of the headaches that a lot of retail traders have. Now, there's two other things to remember about these zones for this lecture we'll talk about. A zone that holds multiple times is more likely for retail traders to be a significant level to buy, as the more times that we touch this level and bounce, the more retail traders will put their orders here in order to take advantage of the consistent price action. But something to remember is you want to be looking very closely at the volume, because if a zone is tested too many times, the liquidity can be eaten up, and the reason the level was strong in the first place can start to dissolve. So an example is, say there is 10,000 orders in this zone that are waiting to buy. Price comes down, say 2,000 of them are filled, price goes higher, we come back, another 2,000 are filled, price goes higher, so on and so forth. That works as long as there's orders, but eventually the liquidity in these zones can dry up as the orders that made it strong in the first place have all already been filled. So if a zone is touched too many times, it can be a major red flag that the zone can be losing the liquidity that made it strong in the first place. So the more that a zone is tested without a reversal, the more likely it is to eventually break. So the last thing we're going to look at before we wrap this first part up is some examples of recent highs that caused sharp sell-off. So if we're looking at QQQ, we can take a look at this level. We had a massive gap up and saw price action ultimately peak out in this zone here. Now price eventually broke above it and found this zone acting as support. But now that price has fallen below this level, we're seeing this zone acting as resistance. A lot of choppy price action is remaining in this zone. So a quick way you can identify these zones is you want to look for the bottom candle of the zone and the top candle of the zone before the breakdown or breakout occurred. So in this example, we see this candlestick marked the bottom of the zone, this candlestick marked the top of the zone before these next candlesticks represented the breakdown of the zone. This is the best way to identify and draw the zones out. In the coming parts of this lecture for support and resistance, I'm going to go a lot more deep into the types and ways to identify support and resistance, as these are just a couple of them. And it is best to know as many of them as you can to improve your edge as a trader, as support and resistances can come in many different shapes and forms. And thus, you need to be aware of the different types that you can draw. But that is going to be it for this first part of the lecture. More content like this for support and resistance will be released in the coming days, and there will be a lot more practical trading strategies that you can use support and resistance for that will be talked about in a lot further depth in that video. I hope you guys learned something here today, and I will talk to you guys soon.